Dear audience, after this short break, we continue today's program with our next session on reinvented markets and financial intermediation. The session will start with a keynote presentation of Mr. Leonardo Gambacorta, Head of Innovation and Digital Economy at the Bank for International Settlements. Afterwards, we will hear the presentation of Ms. Ania Zalewska, Research Chair and Professor of Finance at University of Leicester School of Business. Please give them a warm welcome.
So first of all, I would like to thank the Major Nemezi Bank, the Semla, the OMFIF to invite me to this very nice conference. This session is on reinvented markets and financial intermediation. So together with Ania, we'll focus on the role of technological innovation, how technological innovation has reshaped financial markets, financial institutions, but also the economy. And for in this first part of the session, in my presentation, I will focus on artificial intelligence, in particular generative artificial intelligence, how these affect the economy and the opportunities and risks, especially for the financial system. So we have in mind the large language models, ChatGPT, and they are captured our collective imagination. The adoption of large language models and generative artificial intelligence is has an incredible speed in terms of adoption. For example, ChatGPT, when it was launched last year, it took only 1 week to get 100 million users. 1 million users, and less than 1 year to get 100 million users. So this is something completely new with respect to other general purpose technologies, that is, for example, electricity, computer, internet, the digital phone, they took more. And so this is a characteristic that we have to take into account. There are elements that are new. We need to start to answer to some questions. So this is the questions I would like to try to answer during my presentation today. The first one is, how does artificial intelligence affect productivity? This could be done through various channels. We'll try to see what these channels could be. What is the impact of artificial intelligence on inflation and output? Because the transition here is from productivity, the labor market, the creation of a new task, but also the replacement of some task, and then the impact in different sectors of activity and general aggregates that as a policymaker we have a look at as inflation and output. And then I'll try to go a little bit more deeper into the financial industry and how artificial intelligence could create new opportunities and challenges, and also to arrive to situation of financial instability. And then I will conclude. So let me start with a field experiment that we have conducted at the BIS together with the Ant Group in China. This is an experiment that took place in September 2023, when Ant Group introduced a large language model for programmers that's called CodeFuse, and this was done in a way considering two groups of programmers. One group that we can consider a treat group was informed and used this large language model. And the other group, that is comparable employees with the same characteristics, they were not informed about the large language model, and they didn't use the large language model. So, and then we analyze the effects on the volume of the lines of code. That is, of course, an important indicator of the work output for a programmer. Here in this slide, you can see there is on the vertical axis the logarithm of the coding output, And as it is in the log, you can consider the change in the log as a growth rate. And then you are here the time. The time is 3 periods, and each period is 2 weeks. So this means that if you have 3 periods, it's 6 weeks, before and after. And the graph shows you the difference in the productivity between the treated group, the one that had access to the code fuse, and the control group. And before it was expected there were no differences because of the design of the model. These 2 groups of programmers, they had the same characteristics, but afterwards there is a significant increase in terms of productivity, with an increase that is around 50% in the short term. And this number seems large, but is very comparable with other studies that have been conducted on programming. And we have also very similar results in terms of other areas of business, for example, customer support or writing documents. So there is an effect that is quite already accepted by the literature, that generative AI increases productivity. There is also another aspect that we have to consider is when we have an increase in productivity, is this increase in productivity for everybody, or there is a heterogeneity also in the increase in productivity. And here what we have done, we split the programmers in 2 groups. One is junior programmers with less than 1 year experience, and then senior programmers with more than 1 year experience. And you can see that there is a strong difference in the effectiveness of the large language model that is significant and economically important for the junior programmers, while it is always positive but not statistically significant for the senior programmers. So this means that not all groups of workers, they benefit from this generative AI and the applications. When we look into the senior one, is what happens? Did you use it or not, and so on? What we discover is that the seniors, they use less the large language model because maybe they don't need, they have already experience in terms of coding and so on, but when they use, it is useful for them. And so this means that there are heterogeneity in the workers in terms of the use of the generative AI. There is also heterogeneity in terms of the different tasks. So when generative AI will be more relevant, less relevant, but also it is very important to consider another element that is sectors, because generative AI will be different and will have a different impact across different sectors of economic activity. So let's start with an idea that is generative AI will produce a positive shock to the economy. Economists, we name it as a positive supply shock. So it's the aggregate supply curves just move positively and will increase output, possibly will reduce prices. But the effect is different across tasks and also across sectors in the economy. So what we did at the BIS, we use a multi-sector macroeconomic model to analyze what is the impact on inflation and output. And here in this slide, just I'll give you some preliminary results. So this is just the input chart, because before to give to calibrate the model and to analyze in a simulation what is the impact of this positive supply shock determined by productivity, we had to consider the exposure to AI of the different sectors of the economy, and also consider the employment rate in the various sectors. And these figures already gives you one important indication, that is the finance and insurance is the industry with the highest exposure to industry, as an industry, to the measure of artificial intelligence. Then, of course, there are others, for example, management of companies, enterprises, and the usual suspects you can understand that will be less affected are agriculture, forestry, fishing, hunting, and so on. But so there will be heterogeneity in the effect. I wanted to tell you at this point one element in the analysis is that when you have this kind of shock, you have a shock on directly on the sector that has a more impact on artificial intelligence, but you have also a second round effect via demand, because of course then demand increase for everybody, and this means that there will be a reallocation across sectors that could determine some positive second round effects. And this is what we do in the model. Well, we calibrate first the macroeconomic model that models this productivity shock with different impact across sector. The model features detailed industry structure on both the demand side and the production side. Of course, we use the standard nominal and real rigidities that are commonly used in this aggregate model for economic fluctuation. And then we are able to analyze what it happens to project the implication of a positive productivity shock that is heterogeneous across sectors to the economy. And these are, in this slide, I present the results. You have the result on GDP, the result on inflation, and the result on the reaction of the policy rate. And there are two scenarios here that are indicated. One is a scenario in which the shock is fully anticipated, that is the blue line, and the other one is a scenario in which the shock is not anticipated. And you can consider the potential realization of the shock between these two lines, because you can consider also maybe two scenarios that is in the middle if the shock is partially anticipated. And you have different realization of the shock. Imagine that the shock is completely unanticipated. You will have an increase in GDP because higher total factor productivity increases the economic output capacity, but this is a sort of a positive supply shock. So this will reduce prices. So at the beginning will be disinflationary. So, but then after 5 years, because of the second round demand effect, this will produce inflationary effect into the economy, and therefore the policy rate will be initially reduced because of this inflationary effect, and then subsequently it will be increased. So this means that artificial intelligence could really have aggregate effect on the economy that are very important to be analyzed, and the real effect should be also considered by the financial markets and the financial systems in consideration of their business. So the next step is to see what could be the effect of generative AI also on financial system in terms of opportunities and challenges, and in particular what could be the risk determined in terms of financial stability. So financial sector, we have seen that is among the most exposed to AI, reflecting this high share of cognitive tasks and abundant data that are the input for this kind of a model. But with the generative AI, what is new? You can tell me, well, banks, they already use machine learning models. They already use applications in several areas, but nothing substantial as we have seen in the last years, if not maybe the amplification of certain kind of propagation of risk. So what is important is to understand what is new with the generative AI, and why we, as a policymakers, we need really to stay ahead of the curve and to understand the difference, because we already observe some signs, but they are not maybe evident, but they could propagate quickly in the future. And there are three characteristics I would like to highlight. First is automaticity. that is, these models, they really need no human intervention. For example, there are some credit intermediaries, they claim they can produce a credit decision automatically in 3 seconds. And therefore, the second characteristic is the speed. So there is a possibility for these models to have a decision to take a decision on some very complex problems in fragments of seconds. And the speed we have seen is not only in terms of the speed in the decision and in the processing of the data, but also in terms of the diffusion. That is really not comparable with electricity, is not comparable with computer, internet, or mobile phone. If you look at the data, it's completely different. So there are opportunities and risk for the financial market and financial institution that I have synthesized here together with the help of other colleagues at the Bank for International Settlements, together with Anton Korinek and Stein. Here we have divided the opportunities and challenges and financial stability consideration in the financial system, considering 4 areas of activity: financial intermediation, insurance, asset management, and payments. And if you look at the first row in terms of opportunities, it is clear, and there is a lot of new evidence on this. It is possible to have enhanced credit scoring using non-traditional data, and this brings a lot of financial inclusion. We have a lot of papers that point to this in terms of both fintech and big tech companies using artificial intelligence models. We have also a lot of improvement in terms of back-end processing and, in general, improved customer support for banks. With a chatbot, we can really have a lot of information without interacting with a human resource. On insurance, we have certainly possibility to detect better the risk analysis, and this is using unstructured data, and we can have easier regulatory compliance. This is all automatized, and speaking with the insurance companies, they really point out to the fact that there is a reduction in personnel to manage with the documentation. Asset management, more and more on robot advising. There is also a possibility with asset embedding, meaning the opportunity to understand clients' behavior for their portfolio just looking at their composition of the asset they select. New products, also in this case, customer service. And in payments, incredibly enhancements in terms of detection of fraud and anti-money laundering application. But of course, this is only a side of the coin. There is also another side that is challenges. And for example, in insurance, yes, there is a better risk analysis, but there is a serious problem of crime skimming. For example, in I don't know, for insurance of car insurance, only the best driver would be selected and avoiding the last one. Health insurance is, of course, something that is even worse from a welfare point of view. Only the healthy could be insured. These mechanisms are a black box mechanism. Machine learning, they are also black box mechanism, but with some form of Shapley value consideration, one could think a little bit more of what is going on, also with the Bayesian approaches. But with the Gen AI, this is very, very difficult. There is a problem of hallucination that we also face when we use, for example, ChatGPT. Sometimes we receive a very plausible answer to our question, but they don't make any sense, but they're plausible. there is a problem of data, because this model, they use a lot of data, and the quality of the answer, they depend on the quality of the input of the data. So if the input of the data is not good, what you receive is garbage. And then, of course, there is a serious problem in terms of the macro side for the financial system, because we don't know what is going on into the labor market. There could be displacement, so the financial system could also suffer this. In terms of financial stability, the jury is still out. We really need to understand what artificial intelligence could cause, but of course, there is an exacerbation of herding, a uniformity in robot advising. There is more interconnected and procyclicality. So, for example, if financial institutions, they use the same foundational model, they could generate a situation of systemic instability in case this foundational model is subject to a cyber attack, as in the case of cloud computing. In a lot of situations, we, for example, for macroeconomic model, we rely on time series that are too short to tell us what is going on, and of course there is always the possibility that, especially in the extreme cases of general intelligence that we see in the movies, but there is always the possibility that there is a misalignment. That is an alignment risk that we tell to the machine to do something, and the machine, for some reason, they basically they act differently. So let me just conclude with just a few points to sum up what I have elaborated in my talk. So first, artificial intelligence is adopted very rapidly by household and firms, in a way that is completely different from other general-purpose technology. We have seen that there is, in general, consensus on the fact that there will be increasing productivity, especially on cognitive tasks. The impact on labor markets is still uncertain, because on one side there will be the creation of new tasks, and on the other side there will be, of course, a labor reallocation of other tasks. Macroeconomically, we have seen that the effects on output and prices really depend on two factors. First is expectation, how much agents will anticipate these effects in their behavior, and on this skill mismatch, because this is very different across sector. And of course, artificial intelligence will create great opportunities and challenges for the financial system. I have to say that from an economic point of view, the profession has still to do a little bit more effort in terms to analyze the effects on financial stability that are very difficult to predict at the moment. And finally, given the fact that artificial intelligence is without nature, is as a nature that is borderless, there is really a need for coordination across jurisdiction to create new principle, because regulation is so difficult that it is almost impossible to create rules that will not change through time. So it is very important to create some kind of rules that are based on mostly on principle that we can follow together in combination across jurisdiction and across internationally. Okay, I'll stop here, and thanks for your attention.
Thank you, Mr. Gambacorta. Ms. Zalewska, I pass the word to you.
Hello, thank you very much. Thank you to the organizers for inviting me. They definitely had lots of choices. And thank you for staying here. I hope you are not only because at the end of my talk you will get a lovely lunch, so there's incentive not to move. We are really discussing lots of issues in these 2 days. And my talk is slightly different. We get lots of empirical evidence. There's lots of data, lots of statistics, lots of processes that you observe with naked eye. My talk will be more theoretical. I'm not a theoretical financial economist. I do empirical studies, but the two papers that my talk will be based on are purely theoretical. Okay. So traditional story when we think about banking sector is that there is this banking sector, bank, a typical bank, whatever we call it. And then we've got liabilities, depositor, we've got depositors who put money in the banking sector, and we've got those who bank finances. And of course, because of a mismatch that deposits are short-term, investments are long-term, then we've got mismatch problems, asymmetric information, what banks do, regulation spins around it. There are numerous papers that document, how difficult it is, and that we are here today also shows that regulation of such a simple model, simple setting, it's really difficult. However, what happened in the last few decades is that to this difficulty of the system, a new element entered. This is this digital banking, as it was called in one of the previous talks, or shadow banking. There are institutions that are not regulated, but still grab some of the depositors. They allocate money in a different way that a traditional banking sector would do. But this is not only a problem of getting some of the share of traditional banks, but of course they affect traditional banks as well. They affect them, how they develop, how resilient they are, etc., etc. However, even when the talks were given today, even by Professor Ben-Melech, it's not only that there is this big shadow unregulated sector that causes trouble, that causes extra attention from our side. The issue is that the banking sector itself, it's not homogeneous anymore. Right? We just had an example of these banks that are still regulated, like SVB, like Signature, that were in the regulated parameter, but yet they are very different. Right? They are different from traditional banks. This traditional model based, as previously was, make equivalent to having branches, but banks that do business in traditional way or have traditional customers, have traditional depositors, whether they are literate or not, it's a completely different story. So the question is what happens if, in fact, it's not only unregulated sector that causes some disturbance, but the issue is within the banking sector. How much do we really understand about what is happening within that system and how regulation is effective when we have such a complex structure? So my questions that I'd like to address today is, how effective is traditional regulation of banks in maintaining banking stability? Is financial innovation beneficial? If yes, to whom? And how does financial innovation affect risk-taking by banks? How does financial innovation affect market structure? And when I will be doing it, I will give just an example, and I will concentrate on regulation like capital requirements and deposit rate ceiling, but this is just to illustrate a problem. What I will be talking about will be really very general, can apply to any kind of regulation that aims to reduce risk-taking, but in fact may induce it in some cases. So the talk will be based on two papers with my co-authors from Bank of England, Peter Eccles, Paul Grout, and Paolo Siciliani. First part of the talk will be based on the first paper, and here I will be looking at the relations that are related to depositors, exactly in line with what Professor Ben-Melech was talking about. And the second part, it's in fact when banks innovate on the borrower side. So, first typo. The heading should be when banks compete for depositors, not borrowers. And when I saw this typo this morning, I had a moment of panic. Oh God, how could I miss it? But then I decided to look at the bright side of life and think, okay, at least it shows that it's not prepared by ChatGPT. I'm human, I do make mistakes. So I will be talking now about depositors. So the left side of the picture that I was showing before. So let us have two types of depositors. Whether they are named literate or illiterate, doesn't matter. For me, it will be that they are passive, which probably is associated with lack of financial literacy, with going forward, checking what's going on, just deposit money and sit there, and those that are active. It means that they would like to take advantage of what is on the market. So when all banks were identical to start with, we had a traditional system. There was only one kind of deposit rate they were offered, so it didn't matter. But now, if there is innovation in the banking sector, and we've got banks that innovate, and here I refer to them as innovating banks that take advantage of open banking. That's why of an API that aggregates funds and provides more specific services. Those banks will compete for depositors, right? And because they compete for depositors, they will increase interest rates, deposit rates that they will be offering those investors, but at the same time, they will be sucking those more active investors, most active depositors from the market. They will also have some passive ones, because if they already operated as traditional bank, those passive investors were there. However, the traditional leg of the system will be restricted only to the passive depositors, because only those who are there, stayed there, didn't move, because traditional banks will be offering a lower interest rate. They will be not competing for those depositors. And in fact, banks in our model we assume that they have a choice. It's banks' decision whether they want to embrace technological progress, and because of that, they are going to compete for depositors, or whether they are going to toddle along the way the system always was, and they will be restricted to having passive investors and offer them low deposit rates. So the question now arises, when we've got those two different types of depositors, what happens on the liability side? How does it affect risk-taking of a bank? So in the paper, we've got a very simple model that we've got three types of assets. Starting from the bottom corner, we've got government bonds, so safe, no risk to start with. And there are two types of risky projects. Low-risk projects, which I don't go into the maths and all the Greek letters that are behind it, but let us imagine it that they are those that are really sort of we would like bank to invest in. So not to take a huge risk of high-risk assets, but to go with a low risk. So what is happening there now? How will this separation of two different types of depositors affect what kind of businesses the banks lend to? So to make absolutely sure that we're on the same page, traditional banks set low deposit rates because they don't compete for depositors. They have a business model as it was. Innovative banks set higher deposit rates because they compete, because they take advantage of open banking. And at the margin, when we think about the system, when system is in equilibrium that decides how many banks are innovating and how many traditional, it's because they have the same profit at the margin. Traditional banks have less customers, but they make more money per customer. Now, innovative banks have a big body of customers, but because they compete for them, they increase interest rate until it's not sustainable. Then, of course, they make less money per depositor, but at the end, they must have the same profit for the model to work and for the right to be in equilibrium. So what is happening next is that let us think that the regulator thinks there is too much risk in the system. There is just this investment of innovating banks in a high-risk asset, it's too big, and we should somehow address it. Let us imagine that the regulator says, okay, I'm going to increase capital requirements. Now, on the side of traditional banks, they cannot lower interest rates that they offer to depositors because they're already at the low, right? They're at the bottom. So what it happens at the end is that the profit starts dropping down. They take the cut. However, on the innovating side of the banking sector, they can pass this restriction onto the customers, onto the depositors, by offering them lower deposit rates. And at the same time, because they do it, so the profits stay the same. So from the perspective of the banks that are in the system, they are traditional and they are not profitable, they are losing money. And then they've got innovating banks that are doing quite well. So those traditional banks have an incentive to become innovating banks because they want to increase the profits. So the effect of it will be, in fact, opposite from what we expected. The effect will be that traditional banks will be becoming risky banks. They will start investing in those more risky projects. And in fact, in total, in aggregate, the risk of the banking sector as such will increase. Please notice that it doesn't mean that risk of individual typical bank changed. Those that are traditional invest still in particular type of low-risk projects. Those that they are high risk, they are innovating, they invest in high-risk projects. It's just that the composition of the market changed. So what is important here to think when we think about regulation, that we have to look at it in the context of the whole market rather than in the context of an individual institution. But now let us imagine that the regulator thinks, oh, well, it didn't work well, so let me increase it even further. So they push capital requirements that high, but even the innovating banks don't find it attractive to invest in high-risk projects. On the traditional side, they cannot move to the traditional sector, to the innovating sector, because it's not profitable either. So they can only lower it and start investing, not even in low risky projects, because capital requirements are too high even to do that, but they will switch to the safe bonds. They will start investing in sovereigns because they don't carry any capital requirements. But the same thing will happen on the innovating side. They cannot just lower the risk-taking to invest in low-risk projects because they are still, as they are not profitable for the traditional banks, they are not profitable for them. So, in fact, raising those capital requirements can cause that the whole system will start investing in sovereign bonds. Okay, it's safe. However, it doesn't provide any finances to the private sector. So this is not also an outcome that we would like to see, right? It can happen. I'm not saying that it has to happen, but this is a possibility. Now, if we think that capital requirements applied to both sides of the banking sector, so they applied to the traditional banks and they applied to the innovating banks. So now let us think about deposit rate ceiling, that we cut it at the level that will stop innovating banks to compete, as much as they can, compete for depositors above particular level because they have to stop. So what is happening once again? Because we stop innovating banks to compete above particular level, it's even better for them because the profits are even higher because they are squeezing return per customer to compete for them and offering as high deposit rate as possible. Now it's cut at a lower level, so they make simply more money because those depositors have nowhere else to go. This is the highest rate that it's on the market, which is very profitable for those banks. So once again, we've got exactly the same story as we had with capital requirements when we've got deposit rate ceiling, even if the regulation applied only to the banks that were taking more risk. So what once again, we got the situation that although we tried to lower risk-taking, it could end up in the situation that risk-taking or the system as such increased because once again, traditional banks are moving to the innovating sector and take higher risk than it was desirable. Now, shadow banking is also something that is widely discussed in the literature, and very often it's related to showing, how bad it is for the traditional sector, that it increases risk-taking, etc., etc. And indeed, these are all true stories, but we could also look at it from a slightly different angle. Now let us think that we got those two groups of depositors. increase capital requirements. So now some of the traditional banks moved to the innovating sector, but some, if capital requirements are really sort of high enough, what will happen is that even this sector may not be attractive. So the innovating banks will move outside the regulated parameter. So in fact, what will happen, what will stay within the regulated parameter will be safer because of the outflow of the innovating banks. So even if we will think that shadow banking would increase risk-taking within the banking sector that it's regulated, it might not be the case as such. So let me now move to the other side of the equation. Rather than thinking about depositors, let me think about lenders. So far I was talking about banks competing for depositors. What if they started competing for lenders? In the story so far, the quality of banking sector was not discussed. It's not, in the model, it's not modeled whether it's good or bad. So it's really exactly along the lines that Professor Ben-Malech said that, technology is always good. What if it's not always good, right? If technology can be good, but not always working to our benefit. So once again, start a story from a simple model that we've got only traditional banks. Traditional banks collected money from the depositors, and here we are not thinking, what kind of depositors. Let us say that they have just collected the money. And they want to lend money to other investors. What they can see is that they have safe projects, and we call them safe borrowers, and they charge them repayment rate of RS. And what they can see that they have risky borrowers, right? This is risky borrowers whom they charge repayment rate RR. But what they can see whether this is low-risk borrower or high-risk borrower. The technology doesn't help them to do that, right? And it's exactly, how many models operate when we talk about banking sector. Now, let us imagine that in new generation of banking services come, we've got our innovating banks, and they introduce artificial intelligence, machine learning, big data, name it, to better understand what's going on the lending side. So although traditional banks only see that they have risky borrowers, those innovating banks, when they look at a customer and look at all the information, soft, hard, whatever, they can say, no, you are low-risk borrower. When they look at another one, say, no, you are high-risk borrower. So they're very good at separating them. Let's say that the technology is perfect to simplify the story. The interest rates, the repayment rates that traditional banks set so far were based on the mix, because they knew that there were some high-risk, there were some low-risk borrowers, but they didn't know exactly who was who. But they had some understanding, so the repayment rate was based on that expectation. Now, when innovating banks come and they start saying, well, who would like to pick up? Let us think that they take, for simplicity of argument, those that are less risky, okay? Doesn't have to be like that, but just to focus our attention. So when they look at people who have been with traditional banks, they say, select them and say, okay, we start sucking those who are having less risky projects to our portfolio. But at that point, they don't have any incentive to lower repayment rates for them because they don't compete for them. Those clever ones have nowhere else to go. They will stay with traditional or will go to the innovating banks because they offer them same rates, but just sounds better, right? But what happens on the traditional side, they know that it's the better ones they are sipping out of the portfolio. So the composition of borrowers changes. So they have no choice but to start increasing repayment rates for those customers that are stay with us. So at this stage, whether you are in an innovating part of the market or whether in the traditional part of the market, your repayment rates will go up. At the same time, on the traditional side of the market, safe borrowers will become more valuable. And because there is flight to safety, interest rates, repayment rates for those safe borrowers will drop. So at this initial stage when innovating sector it's very small, because they still don't compete for borrowers, it's the safe projects that benefit and risky project, regardless of the type, take the cut, right? So this will go in this direction. Now, let us think that the innovating side already sucked in all those low-risk people. Now they have to get more, to grow, they have to start competing. Because they start competing, they want to attract those people. At this point, repayment rates would start going down. But of course, on the side here, both sides will be going up. Safe projects are no more attractive just to specialize them, and high-risk borrowers will pay what is really related to the risk of the characteristic. So to show it on a diagram, to illustrate you exactly those phases that are happening, let us look at this simple diagram. On the horizontal axis, we've got a share of the innovating sector. So when we've got a zero axis, the vertical one, it means that it's zero. There's no innovating sector. We've got only traditional banks. So at that point, we've got only RS, so repayment rates for safe projects, and repayment rates for risky projects. Now, slowly, the innovating sector starts growing, right? We are starting moving to the right of our diagram, and you can see that, the repayment rates for safe borrowers starts dropping down, for risky borrowers starts going up. And at some point, when the innovating sector starts competing for those projects, there is a separation. So low-risk projects start benefiting, high-risk projects pay higher rates, and the rate of safe projects also increases. So what does it mean for us when we think about development? What is good? When it's better? Shall we go for small innovating sector, or shall we go for a big one? Well, it depends. Now look at the same diagram, only sort of selected slightly. So I looked only at the line that applies to the innovating sector. So this is the one up to the point when they are not competing, and then when they start competing. And on the vertical axis, we've got profit for an individual innovating banks. However, and on the horizontal axis, we've got same variable. This is the share of the innovating sector. So when we start at the zero, it means it doesn't exist. It's only traditional sector. And then as we move towards the right side, we've got the growth of the innovating sector. And let us imagine that the cost of implementing machine learning, adopting all those technologies, are very different across companies. So some have relatively small, they can easily adopt, but for some others it's very expensive to do. So our cost line will be exactly like the red one. So what you can see that when the sector is very small, those banks who entered make huge amount of money for the customer, right? But at some point, those who would like to enter and they move to the right, it's not profitable for them because the cost would be higher than benefit per individual customer. But this means that the growth of the innovating sector would stop when there is a crossing of the red and the red and the black lines. It would be small. It would be exactly at the point when it's only safe project that benefited. Regardless of whether you are low-risk project or high-risk project, you would have to pay higher repayment rates. If the innovation of machine learning, AI, etc., it's much flatter, it's cheaper for many more companies to adopt it, the line will be flatter. And then we will move to the growth of that sector when it really benefits those borrowers who have low-risk projects, because this is already on this side when to the right of the critical value of the competing level. So what really matters at this stage is how expensive it is. So from a regulator's perspective, it's really important to ask a question, where do I want to be? If I want to take advantage and really utilize the growth of the industry, it has to be big, sufficiently big that benefits are observed, and indeed lower risk projects are being financed at a lower rate and attractive. However, if you now even assume that costs are flat, of course, if they go below, nothing happens, but so let us say that it's like the line drawn on the screen. What we have, multiple equilibria. And what we once again would need is to help the system to grow, to benefit, and to ensure that we are on the right side of the dashed line rather than on the left side of it. Now, this was under the assumption that we have perfect technology, that when innovating banks come and they look at us, they say, oh yeah, you are low risk, you are high risk. What if it's not the case, as it is in real life? So technology is good, but not perfect. Diagrams that I presented are sort of special cases. In fact, in the paper they are more complicated, but to give you an intuition, if you think that there are lots of low-risk projects in the market, and that the technology is maybe not perfect, but still good, so when I look at someone, it's a high probability that I will pick up low-risk borrower, then this innovating sector will specialize in attracting low-risk borrowers. So we will have something what it's called in the literature cream skimming. However, if technology is not good at all, it's a low probability that I really pick up who I want. It's sort of if I want a low-risk project. And in fact, there are lots of high-risk projects. Those low-risk projects are really rare. Then for innovating banks, it will be much more attractive, in fact, to start fishing out from those customers, those with higher risk, because probability that I really have them and I charge them the right rate of return, the right rate of repayment, it's higher. Because what they don't want to do is to start sucking out people, thinking that they take low risk, give them low repayment rates, and in fact have a whole bunch of high risk borrowers. And in this case, when we've got a big body of high-risk borrowers, and technology is not very good at separating low from high risk, then you may end up with bottom fishing. So, conclusions. First of all, when we think about regulation, and when we think about how the banking sector evolves, of course, we may wish that we deal with illiterate audience, right? But our banks, depositors are not illiterate, they are literate. And what it really means that it's not only that the banks have to embrace the technology, but they really have to adjust the models, how they deal with those customers. But it also means that the regulator may need to be more vigilant. That looking only at the lending side of the banks, which is not observable very often, it's one thing. Whether it's possible at this stage or not, I don't want to comment on that, but it may be important to look at the depositor side, what customers bank have. And I think it was very clearly the message of one of the previous talks. Now, when it comes to fintech, it brings benefits, but they are not guaranteed. We should not take it for granted that the moment we start innovating will be the same. All right? It will be always better. It can, but we have to work hard. Free lunches are rare, right? Especially when it comes to sophisticated solutions. What it really matters is the quality. what it really improves, how good it is, how really fintech helps bank to improve the services they provide, how costly it is. Very often in all those debates that we have, we forget about the cost that is behind it. But it has a tremendous impact on how the industry evolves. And of course, structure of the market. One size does not fit all. So in one market, one structure of regulation might be beneficial. In another market, regulators might need to go for something completely different. So what are my policy implications? I'm running out of time, I can see. As I said, one size does not fit all. What it's really important is that when, let's say, going back to open banking, when the sector is small, it may be beneficial to have low capital requirements. Because then the cost of dealing with really small, risky part of a business will be smaller still than taking benefit from having big size of the market that invest in low-risk projects. However, when the, let's say, open banking, this innovating part, it's really already big, then it may be more beneficial to have high capital requirements and have much stricter policies. But once again, we have to be careful what we wish for so we don't throw the baby with the bathwater. We don't definitely want to completely kill lending to private sector and just keep investing in government bonds. Right? This is not what the banking sector should go as a safety net. Now, when it comes to machine learning, as the other side of the equation, when we think about how banks lend, once again, it's important to reconsider where we want to be. How much support the sector needs to be offered to grow big and start benefiting at least those who invest in low-risk projects, rather than let it go and some of those institutions become very profitable and very unstable and bringing extra risk to the market. Thank you.
Thank you, Ms. Zalewska. Not to take too much time from our lunch break, we will take a very short question from the audience. If anybody would like. Okay.
Thank you. Very interesting topic, very new, and we still need the tools to understand this. So my question, very simple, goes to Leonardo. Is I think one of the key aspects that you might be missing on the risk is the complexity, because the software complexity is increasing a lot. It is very hard to demonstrate that a program does exactly what you want to do. This is a theoretical result on computer science. So when you have more code involved on the process, so the possibility of errors increases a lot. So now with having these new tools incorporated into the financial system, so the complexity increases. So I wonder if you have also considered that on the risk, and also the risk of cyber attacks, because again, there is more code going to be there doing some stuff for the financial institutions, which opens some points of vulnerability. Thank you.
So thanks a lot. These are very good points that also allow me to elaborate a little bit more on them. So complexity is an extremely relevant factor that it is let us as a policy makers very nervous. For example, when I mentioned the black box mechanism, you know that the machine learning models are used in central banks for doing forecasts in a number of fields, but they don't explain us the mechanism, and sometimes it is very difficult to use them because even if they have a good track record in terms of forecasting, it is difficult to explain what is going on, and therefore, even ex post, they are difficult to be used. There are also some legislation in which models, and especially credit scorings, that are not able to explain why, for example, a credit is not accepted, are simply not allowed by law. So there are a lot of elements in terms of complexity that have to be considered. And the cyber attacks, they could become more frequent than now. Generative AI could really mimic ourselves, could mimic, for example, an email that I write, or my face, or the way I speak. Phishing, of course, is the most evident case for increasing in cyber attack, but there are a lot of other areas. Central banks, for example, are thinking about this very hardly, and there are a lot of mechanisms through which generative AI can be used to protect ourselves. So there will be a sort of a battle using generative AI as an opportunity, but also as a challenge, and the same for the financial system. But complexity and cyber attacks are relevant points that have to be tackled.
So very brief, cutting, I promise. Thank you both, Leonardo, Ania, super interesting. Leonardo, I also had a question for you. So I was thinking, one thing we know about banks is the importance of relationship lending and soft information. And probably technology will advance at some point to try to replicate the possibility of capturing this information. But one role that we assign to banks is to perform a sort of counter-cyclical behavior, not in the macro sense, but in the sense of the life cycle of borrowers, firms, and households, to be there when you need to renegotiate a loan, roll over your debt, right? And in that particular moment, probably all your indicators are pretty bad. You lost your job, you don't have income, you have kids, you need to pay your debts. Do you see any limitations in the possibility that transition towards machine learning and AI-based banking could maybe hinder the possibility of bank to capture this information and use it to take decisions, particularly in the bad part of the cycle of a borrower?
This is a very, very interesting question. There is a huge literature with respect to the difference between relationship lending and transactional lending. The application of machine learning and the new Gen AI on financial intermediation is a more of an extreme case for transactional lending. So this means that big tech, fintech, they are not going to rely a lot, or if not at all, to soft information and the duration of a contract with the client. They're very smart. If something changes, they will cut the loan. So this has implication in terms of the credit cycle. So while in the past, in a lot of jurisdiction, lending relationship has been a caution against the consequences of a crisis. I think about my own country, Italy. There is a long tradition of the relationship between small banks and small and medium enterprises. And the bank, accumulating information, they don't want to lose this informational advantage. They tend to protect the client in the case of adverse condition in order to maintain this relationship and, in a way, to rent extract from the client also in normal times. All these, I believe, will be lost in the case of this kind of credit, with macroeconomic consequences in terms of the credit cycle that is not full explored, because there is another side of the coin that is this kind of loans, they don't need collateral. So this means that if on one side we lose the soft information, on the other side they are less reliant on collateral, so they react by less to the value of collateral over the cycle. So macroeconomically, these two forces are still full to be evaluated, but I agree with you that this is something like a question that we need to answer as a macroeconomist in the near future.
Thank you very much.